A wonderful day to you all. Welcome to Nifty Sense. Today, the Indian markets didn't just move, they breathed. While the headlines might shout about green numbers, there is a hidden narrative beneath the surface. Have you ever wondered why, in a world of global uncertainty and geopolitical storms, the Indian market suddenly found its footing today? Is it a genuine recovery, or are the big fish, the institutions, simply repositioning their chess pieces before the union budget? Let's pull back the curtain on the mechanics of January 28, 2026. The pulse of the day, Macro View 1, Closing Figures. Nifty 50 to 25,342.75, plus 167.35, plus 0.66%. Sensex, 82,344.68, plus 487.20, plus 0.60%. India VIX, 13.53, minus 6.41%. The fear gauge cooled down significantly, suggesting that the insurance premium traders pay for protection is getting cheaper. Top 10 impactful headlines. India-EU FTA breakthrough. Optimism regarding the conclusion of the India-EU Free Trade Agreement acted as the primary catalyst, promising smoother trade highways for Indian exporters. Tragedy in Maharashtra. NCP chief Ajit Pawar and 4 others passed away in a tragic plane crash near Baramati, a significant geopolitical event that may impact local governance but saw limited immediate market reaction. Budget anticipation. The Parliament's budget session has begun, with Jefferies projecting a fiscal deficit target of 4.2% to 4.4% for FY27. BEL's power surge. Bharat Electronics (BEL) reported a 20.4% jump in net profit, hitting 1,579 crore rupees. Energy Alliance, ONGC and Reliance Industries, RIL, signed an MOU to share deep-water resources on the East Coast, a massive move for operational efficiency. Global supply storms, U.S. winter storms and geopolitical tensions pushed Brent crude up 3% to $67.57, affecting energy stock valuations. TCS Global Footprint. TCS announced its largest delivery center in Brazil, 3.3 billion rupees investment, signaling continued global IT dominance. The Ethane Bridge, ONGC, signed a pact with Samsung Heavy Industries for Very Large Ethane Carriers, VLECs, to secure India's petrochemical feedstock. Railway momentum. ABB India secured significant orders from Titagarh Rail for driverless metro propulsion. The gold rush. MCX gold futures surged over 4% to reach 1 rupee, 64,150, reflecting a flight to safe haven assets despite equity gains. Sectoral pulse. Top 3 gainers. 1. PSE, Public Sector Enterprises, up a massive 4.61%, led by BEL and ONGC. 2. Metals, driven by global price stability and FTA hopes. 3. Energy/oil and gas, reacting to the RIL-ONGC Resource Sharing Pact and rising crude. Top 3 losers. 1. FMCG, weakness in heavyweights like Tata Consumer, minus 4.55%. 2. Consumer durables, dragged by Asian paints, minus 4.22%. 3. Auto, under pressure due to valuation concerns in Maruti and M&M. Institutional flows, the tug of war. FIIs, foreign institutional investors, net sellers of 3,068 crore rupees. Think of them as global tourists. They are currently cautious and packing some bags due to global interest rate uncertainty. DIIs, domestic institutional investors, net buyers of 8,999 crore rupees. These are the anchor tenants of our market. Their massive institutional footprint is the primary reason the market, stayed standing today despite foreign selling. The big mystery today: why did the market rally despite 3,000 crore rupees of foreign selling? The answer lies in a historic geopolitical event. Yesterday, India and the European Union sealed a mother of all deals, the India-EU Free Trade Agreement, FTA. This agreement eliminates tariffs on 90% of Indian goods. In professional terms, this is like removing a toll plaza from a major trade highway. The market isn't just reacting to today's profit, it's pricing in the massive reduction in export friction for the next decade. To understand why the market moved, let's use the supply chain analogy. Imagine a massive factory, the global economy. When a storm, geopolitical tense winter storms hits the road, the cost of fuel, crude oil goes up. Brent crude is currently at $67.57. This usually hurts businesses. However, if that factory suddenly signs a priority shipping agreement, the India-EU FTA, the promise of cheaper shipping in the future offsets the current high fuel costs. Cause and effect, the FTA catalyst, lower tariffs equals higher margins for Indian metals and textiles. Result, relative strength in those sectors. The budget gravity. With the union budget just 3 days away, February 1st, the smart money is moving into public sector enterprises, PSEs, betting on the government's continued focus on infrastructure insurance, CapEx. The earnings filter, companies like BEL, reported massive beats. When a company's order book, prepaid work, grows by 24%, it creates a value moat that protects it, even if the broader index turns red. Green flag deep dive. 2 stocks showing unusual strength. 1. Bharat Electronics Limited, BEL, the shield moat. The narrative, BEL surged 9% today. This isn't just momentum, it's a reaction to their Q3 FY26 results. The moat, their order book, stands at a staggering 73,015 crore rupees. Analogy, imagine a caterer who already has bookings for every single weekend for the next 5 years. That's revenue visibility. Even if food prices, raw materials fluctuate, their business is secure because the demand is locked in. Institutional footprint, huge volume spikes indicate an accumulation zone by domestic mutual funds, who see BEL as the backbone of India's defense insurance. 2. ONGC, the resource sharing play. The narrative, ONGC advanced 8.2% following a strategic MOU with Reliance Industries, RIL. The moat, they agreed to share supply vessels and deep water resources. Analogy, this is like 2 rival delivery companies, FedEx and UPS, deciding to share the same truck to reach a remote village. It slashes operational costs, OPEX, and boosts the bottom line. Green flag, the stock is trading at a PE ratio, price to earnings, that suggests the market is still underestimating its future cash flows from the petrochemical expansion via their new ethane carriers. The dark horse, the PSE sector. While FMCG and auto sectors showed structural weakness today, Asian paints down 4.8%. The Nifty PSE index jumped nearly 5%. This sector is the dark horse because it's where quiet accumulation is happening. Most retail investors find public sector stocks boring. However, the institutions are looking at the order inflows. From railway orders for ABB and Titagar to defense orders for BEL, the government is the biggest customer in the country. In a high interest rate environment, the customer who always pays, the government, is the safest bet. Today's core lesson. Watch the anchor, not the waves. The FIIs, the waves, are volatile and move with the global wind. The DIIs, the anchor, are staying put. Wealth preservation isn't about catching every 1% move. It's about ensuring your capital is parked in companies with a value moat. Business is so essential to the nation's infrastructure that they cannot be allowed to fail. Professional closing thought. In a market hitting new peaks, the greatest risk is not missing out, FOMO, but overpaying for mediocrity. Stick to sectors with an institutional footprint.